Okay, I think we'll make a start. Well, welcome once again to this Bloomberg Intelligence webinar. We're very pleased to be co-hosting today with ING. I think we've got a very interesting event for you titled, Will Elevated Commodity Prices Hasten or Delay the Energy Transition? My name's Roger Thompson. I'm the Regional Marketing Analyst for BI. Over the next 30 minutes, we'll hear from the team. But before I get going, I'd like to just cover a few housekeeping items. This event is being recorded. The playback and slides will be available. We do encourage questions, so please enter them into the chat box. And if we don't get through them all, we will certainly make an attempt to come back to you at a later stage. Now, the team today that we'll be hearing from is Gerben, Hieminga, ING's Renewable Energy Analyst, and then within Bloomberg Intelligence, Rob Barnett, our Clean Energy Analyst, and Patricio Alvarez are one of our energy team from the energy team based in London. Now, I will now hand over to Gerben. Over the next 30 minutes, we'll have 3 10-minute presentations, and then we'll open up the lines to Q&A. Thank you.
Thank you, Roger, for that introduction. I will start sharing my slides. Yeah, they should be on now. So indeed, will elevated commodity prices hasten or delay the energy transition? That's a very actual and difficult topic at the moment, and I will take a more policy perspective on that. After my presentation, Rob will go into the renewables elements of it, and Patricio will discuss the implications for utilities. But first of all, there's never a dull moment in the commodity markets, and certainly not now. And there are so many factors going on that I like to use a very simple but useful model that consists of 4 elements. And the first one is the energy transition. And as all of you probably know, if you look at the long-term energy transition models, then they predict that coal needs to be peaked and has already peaked on a global level. Oil will do so in 2 or 3 years, hopefully, according to the models. But gas could actually increase demand by another 10 to 15 years, as it would act as a transition fuel. And the current situation has really turned that trend upside down. So that's it on the energy transition side. On the economy side, there's a bit of a mixed picture. Obviously, growth is slowing down. We have higher interest rates and also financial conditions are worsening. But on the positive side, also China is now, at least at the moment, reopening its economy again. So a bit of a mixed picture on how the economy will evolve. That is, of course, all driven by the geopolitical situation, and also the commodity markets in itself have a major impact on the current price levels in the market. Whereas in the last couple of years, policies and also market participants were really focused at reducing the supply side at a much faster pace of fossil fuels than demand could keep up with. And all in all, this all impacts each other, and that's why at this moment it's so complex and hard to predict fossil fuel prices. And as such, we are not focusing prices anymore here at ING, but we use scenarios. A month ago, we published our latest scenarios. And if you look at Brent oil, then we predict that in our base case scenario, the orange line, it could reach to 125 by the end of the year. And if the crisis in Russia with Ukraine will find a solution anytime soon, then prices could lower in 2023. On the other side, if we are in for a longer conflict, in the winter, we could see price spiking again up to 150 euros per barrel. And the same picture we see in the gas markets, where in fact, if it escalates, we anticipate a future price spike of about 200 euros per megawatt hour. And then we are in for much higher prices for much longer. But again, that's not the base case scenario. If we find a solution for the conflict, soon then prices could level off from this current high price environment. So it really depends on what world you believe in and what we think these commodity markets will evolve. Now, if we look at a policy perspective, then one thing certainly has changed, and that's the strong focus on the sustainability part of the energy transition. Under Europeans' Green Deal, the Fit for 55 strategy, that was all really focused on the sustainability part, and it actually ignored to a large extent the reliability of the energy system and also the affordability. There was not much of a need because energy was so cheap at the time. And that has been changed by the Repower EU strategy, and at least it's much more balanced at the moment. In itself, that's a good thing. Now, if we look at the Repower EU strategy, then the main goal is to substitute the 155 billion cubic meters of gas that comes out of Russia. That's about 35% of the total gas balance in Europe. You use over 500 billion cubic meters of gas. And Repower EU aims to do it, reduce the 155 BCM by 100, so 2/3 by the end of this year. And 50 will come from increased LNG imports. And actual fact, we are on track at the moment to reach that target if the LNG flows as of today continue to progress through the end of the year. Also, 20 BCM needs to be replaced by renewables. Rob will tell you all about that in a moment. So those are the major items. Well, personally, with ING, we think that 2/3 is a bit ambitious. We think that 55% is more realistic. And currently, if you look at what happened in the market, then Russia reduced its supply to Europe by 23 BCM, but that has been covered by increased LNG imports. Now, so far, so good. Not a major crash at the moment, but if the situation deteriorates, then Europe might be in for some hard choices, particularly in the Netherlands, for example. Do we need to speed up gas production in the Groningen gas field that we actually wanted to reduce? Coal-fired power plants could come into focus, particularly in Germany, the Netherlands, a bit in France, a lot of Poland, and also Portugal has some coal capacity available. And for example, in Belgium, it's likely to trigger talks about delaying the phase out of nuclear power plants, and all come at a cost at these local societies. Now, Repower EU, it's a comprehensive measure. It's a full package. It's well thought, but I also have some critics. And the main one is that it's really focused on the power sector. And if you look at energy use in Europe, then you see that only 20% of our energy is used for electricity purposes. A third is used for transportation, mostly oil demand, but half of the energy use comes from heating and feedstock purposes. And hence, Repower EU has been better called Reheating EU. On purposely, they did not do so because greening the heating system is much more difficult than greening power systems. So hence the focus on renewables. Now, the best thing about Repower EU, in my view, is that it talks about really speeding up some of the transition pathways by relaxing procedures. And that is urgently needed because in some countries it needs years to build large offshore wind farms or solar farms, for example. They are talking about introducing free rule zones, and that's really a game changer in EU policies. But they're also talking about increasing participation among European citizens. And we all know that participation is not a guarantee for speeding up the transition. So there's a bit of a conflict over there. There are also some bottlenecks going on. First of all, the power grids remains a persistent barrier, and also the labor markets, and also more increasingly more the material shortages. If you look at steel prices have gone up 75% last year. They are very important for wind turbines, and also the elements for solar panels are up almost by 50% in the past year. So it's not easy to make the business case at the moment. And also politicians start to talk about taxing utilities. But as Patricia also will highlight in his presentation, we really need those utilities in the energy transition to green the power systems. Now, when we talk about commodity markets and the energy transition, that is usually in the context of normal market functioning. So price mechanisms work, prices can be high, but there are no shortages of gas or oil supplies. And the recent conflict really has put that to the forefront too. So far, the market is still working. Prices are high, but curtailment has been limited. Here we see the graph of the industrial production in Europe. The line below is steel production, and that is 25% below what it was before COVID, actually. And also fertilizer production is a bit lower because of the high energy prices. But this was a great surprise to me that the impact on industrial production so far has been modest. But that could change if rationing policies are needed, and governments are looking for that. They are defining the ways how to do it, and all countries do it in the same stepwise procedure. So first of all, they introduce like tender-based procedures where they ask companies to reduce their gas demand, for example, an aluminium melter or a steel production, and the company gets paid for that in an auctioning system. They also call for voluntary gas savings, for example, by households, by showering less, or by putting down the thermostats. And if that is not enough, then we enter the realm of mandatory shutdown and forced demand reductions. And first, that will be done by non-critical activities of businesses, the large gas users. So think of the aluminium melter or the steel factory that has to close down. If that is not enough, then we can also shut down or the critical activities. Think, for example, of hospitals, of power system, gas-fired power plants, or think of municipalities. And of course, this is the type of activities you don't want to enter because it can be very destabilizing. If that's not enough, then mutual cross-border solidarity can be called upon. For example, if Germany is being cut off from gas, and it has taken all the measures that we just discussed, then the Netherlands might be asked to increase gas flows to Germany, even if it has problems in meeting demand by itself. And finally, also the protected consumers like the households, the small and medium enterprises could also be reduced or cut off out of gas. Now, this is far from reality, luckily. But if the conflict lingers on, if the energy system will be weaponized further, then this could also have a huge impact on the energy transition and how commodity markets can impact the energy transition. If this starts to happen, then we won't focus so much on sustainability for some time to come, because we have other concerns. So all in all, my conclusion, what is the impact of commodity markets on the energy transition? I personally find that a very hard question to answer. You clearly see that the political response is to increase renewables. That is good, that is laudable, that can also be done. But we must not forget that renewables are not a perfect substitute for the fossil fuel use that is driving the commodity markets at the moment. So we also need to look at LNG and possibly coal use. And of course, that is not beneficial to the energy transition. Speeding up the energy transition in heating demand is much more difficult. Those are the hard questions. Obviously, we have the game changer of hydrogen at the horizon. But before we are there, we probably need to look at greening fossil fuels too. And for example, with carbon and capture storage. And that's what is not much in focus at the moment in all these plans for the energy transition and commodity markets. So those are my conclusions. Back to you, Roger.
Okay, thank you very much. Fascinating, Gerben. We will just bring up Rob's slides, and obviously a very interesting segue with renewables not being the perfect solution. Rob, I'm sure you have views on that. Over to you, sir.
Well, thank you. You know, one of the funny things about doing events like this is, you know, we coordinated on topics, but we didn't really coordinate on messaging. Each one of us runs our own sort of book of insights. And I'd say, Gerben, you and I probably agree on most of the big picture items, maybe some slight difference on pace and timing. But I certainly agree with you that the very near term and obvious policy response appears to be more renewables. I think to handle some of these bigger questions that you raise, maybe the European Commission and European Union might want to consider electrifying as much as possible. If it can be converted to electricity, you may want to do it, may help with some of these longer term problems. But let's come and hone in on kind of where renewables are at. So, Roger, if we could go to the next slide. Look, no matter what way you cut it, we are in just an unprecedented time in terms of thinking about the traditional energy markets. Versus 2 years ago, European natural gas is 6 times higher than it was. We've backed off in recent weeks from some of the highs we saw right after the Russian invasion of Ukraine, but we're still very elevated. Carbon price, another key driver of the energy transition narrative, is up 3x compared with where it was just 2 years ago. And some of the changes there might actually be more structural than transient in terms of the sort of geopolitical factors and everything that have flipped the traditional energy markets upside down. Oil's up 2.5 times roughly, and our broad Bloomberg commodity index is up 2x. So, when I see this kind of thing, I'd almost say forget policy. It doesn't really matter. The market signal is screaming two really important things to us. They're saying produce more, certainly, and consume less. And the path to consuming less gas, especially within the electricity sector, is almost certainly going to be renewables, at least in our view. And on the upstream side of the equation, produce more. I think the response will be fairly limited. We do not have the equivalent of the shale oil and gas revolution here in Europe. There's certainly a part of the equation that the USA can flex a little bit more than we can over here. But I think the focus is going to be on using less in the near term. And let me tell you a little bit about why that is and how renewables come into it. So if we could go to the next slide, Roger. I think if you want to do anything besides a wind or solar project in Europe, you're going to be waiting for a very long time. Nuclear has a lot of great attributes. It's carbon free, it's base load. But the problem with nuclear, or one of the problems with nuclear, is good luck building a plant in under 10 years. Everything goes right. Maybe you could do them in 5, but there's just no coordinated effort there. So very unlikely that nuclear power can come to any sort of rescue in any kind of time frame that we're talking about here today. Gas plants can be built relatively quickly, but the whole objective in probably the lawmakers' minds is to use less gas. And by the way, gas is very expensive right now. Coal could be another option, but probably not in Europe or anywhere in the West generally right now. I do agree with Gerben's initial opening remarks that we may have already seen a peak in coal demand, and let's see if time bears that out. So I think in the very short run, we're going to see a lot more solar. It's the type of project you can build most quickly, and then in short order after that, we could potentially see some big ramp up in what's happening with wind in Europe. Wind's got a little bit longer lead time, but as Gerben was mentioning, there's some policies that they're trying to enact that hopefully help streamline it, make the permitting side of that go a bit quicker. Let's see if they can actually make that a reality, because if they can, the construction timelines for wind are relatively short and can help provide some relief here. So we could go to the next slide too. So in addition to having a very quick profile in terms of rolling out renewables, they're just simply the technology you can build most quickly. I would argue that they are the most economic form of electrons to put on the grid right now. So solar is the most cost effective, but it's neck and neck with wind. Prior to the gas market going haywire, gas would have been in a close competitive range with solar and wind, but gas nowadays would be much higher than I'm showing on the chart. So the way to read the chart that's on the screen, by the way, is this is levelized cost of electricity, very common way of kind of thinking about, what's the full cycle cost of putting a solar or wind power plant onto the grid. Reach out if you've never really thought about LCOEs. Happy to walk you through kind of the calculation and how to think about it. But and it's an imperfect calculation, but the way to read it is, solar and wind are very cheap electrons. Gas and coal, the pink ones there, this is done using a sort of equilibrium gas price or equilibrium coal price. If you put anything like the current market into this kind of calculation, the gas bar or the coal bar would be up much closer to that orange bar that's floating up above. So solar PV, wind, onshore, offshore, even solar or wind paired with battery storage, these technologies are very economic compared with wholesale power prices here in Europe right now. So we think the economic forces will be the key driver here. Anyone who can do solar as quickly as possible has a lot of incentive to do it because that solar project is going to come in so far below where power prices are at today. So if we could go to the next slide real quick, just a couple of other things to help frame kind of where the market's at. We've done some analysis looking at the Repower EU proposal and sort of said, look, if everything goes as it could go, you put some rosy colored tinted glasses on and do everything in your power to get gas from Russia or just gas generally out of the power sector. We think it's possible that you could do this in a sprint fashion over kind of a 4-year time frame. And gas represents roughly 20-something% of electric power generation in Europe. Renewables are also about 20%. So the basic idea would be how quickly can you take gas to zero and push renewables up to closer to 40%. And if under the scenario we looked at, look, if you can have wind grow at a compound annual growth rate of something like 11%, solar grow at a compound annual growth rate of 27%, which sounds like a lot, but let me frame that, then you could basically get off of gas in the power sector in Europe by the end of 2025. And just to sort of broad framing, the global solar industry grew about 27% last year, so roughly in line with where we're at. This year, it looks like it's going to grow more than 30%. So the solar industry is just rip-roaring, it's booming, and I think there's real potential to hit this goal. In terms of the wind sector, well, it's had a little bit more of headwind here recently, but I think there's a lot of growth potential there, especially when you include offshore into the mix. Now, if we could go to the next slide, Roger, just some big framing and concluding thoughts on kind of how to think about the wind and solar business. I know most of the folks listening, you're investors, you're sort of saying, well, if you really do believe this thesis, and you say, well, how could you play the idea of wind and solar doing very well? Well, look, I mean, one thing to point out is that consensus for the wind industry is very tepid right now. Essentially, whether you're looking at a Vestas, a Siemens Gamesa, a Nordex, basically the street sees flat turbine sales growth over the next 3 or 4 years. We think there's potential upside revisions to consensus sales estimates simply because we're in an unprecedented environment. There's tons of policy support. The economics work. So we think there's a lot of potential to see the wind industry move faster than expectations at the moment. Very similar for solar. I already mentioned that the consensus expectations for the solar industry are very high at the moment, but they kind of trail off in years 2023, 2024, 2025. Repower EU, high commodity prices could really help the solar industry move more quickly than consensus expects. And so, the solar industry is very heavily dominated by Chinese manufacturers, but there are some ways to kind of think about the industry and think about European or U.S. companies that are exposed to this thesis. So if you looking at Europe specifically, you've got Wacker Chemie, a polysilicon producer based in Germany. You've got REC Silicon, another polysilicon producer headquartered in Europe. You've got SMA Solar, which makes inverters. You've got Landis+Gyr, which makes smart meters. All of those could be potentially tied to a potential boom in solar demand. So some interesting names to look at. They're under our coverage, so you can go read our primers on those companies if you want to learn more. Roger, one more quick slide, because I know we want to move on to let Patricio give some comments. But I would just say also as a concluding remark, that if you're looking at the oil side of the equation, I thought Gerben's comments about the idea that maybe within 2 to 3 years we could see a peak in oil demand. I'm not sure if it'll be quite that soon, but it does appear to be on the horizon, and a key catalyst and a key driver for kind of thinking about that would be what's going on with electric vehicle sales. They are rising very rapidly at this point, and if you want to look at our colleagues at Bloomberg NEF, they put out their big electric vehicle outlook just earlier this week, and one of the concluding takeaways from their report is that 2022 will be the peak year for ICE automobiles, internal combustion engine automobiles, in the fleet globally. So check out their analysis and think through what it might mean for the oil side of the equation. And with that, I'm going to let Patricio pick up the narrative here.
So I will try to sort of link back to what Gerben and Rob have been talking about, and sort of looking at the utility sector in Europe and how the companies are gearing up towards amid this transition that we're talking about. So first of all, let's try and dissect the sector and utilities into two. We'll talk about regulated utilities a bit less because they just face a flat period until mid-decade, and we'll talk about power generation and supply as the other segment, which is what I'll talk the most about today. So first of all, looking into the near-term outlook, and short answer there is it's a very bleak outlook for most utilities generating power. So the chart here, what it shows is Spain's and Germany's power baseload forward month futures. So these are basically spot prices, and we see that the median hedge price of most power generators, or the largest power generators in Europe, is around 60 to 65 euros per megawatt. So this means that in theory, these companies will have to procure energy at higher prices. So what I want to focus on there and try to separate is there are suppliers that have generation, their own generation capacity, which are able to use this as a natural hedge by matching their generation to their customer base and leaving a shorter gap to fill with procurement costs. So that's a very important topic. We see that margin pressure is on the cards, at least until we see this volatility subside, hopefully from next year. Next slide, please, Roger. So as I mentioned before, retail-focused utilities appear to be most exposed. So retail-focused utilities can be described as companies that sell more power than they generate, or essentially companies that don't have generation and just sell power and trade power. In this sense, we've evidenced already a number of bankruptcies. We've seen more than 31 energy suppliers go bust in the UK. More than 40 suppliers go bust in Spain, and several others. In less measure across Germany and the Netherlands, the numbers are a bit lower, and that's because regulation there allows for utilities to pass through costs, and also that owes to the market structure, just because tariffs in these countries are set at a fixed price during a period, so they do allow for a pass through, but it's a bit delayed. So if we can move to the next slide, please. So, okay, beyond this volatility, of course, we've seen retail margins crushed during this past 2 quarters, but beyond this volatility, we could see, especially for power generation, we do see an opportunity to lock in earnings growth by placing power hedges at higher prices. So this chart shows you that 2021 was largely fixed already at 55 euros per megawatt, and 2022 already saw an uptick of about 10 euros per megawatt from 55 to 65, showing that power producers were able to lock in longer term contracts at higher prices. And we see a bit more opportunity for 2023 to keep on placing power hedges at higher prices. As we see on the chart, about 60 to 70% of 2023 power is hedged, with the rest presenting this, like I said, opportunity to place place prices at higher hedges. If we can move to the next slide, please. So now let's move on to the really let's hit to the crux of the matter, looking beyond volatility. is renewable power. So most utilities in Europe are actually at the forefront. The power generation generators in Europe are at the forefront of the energy transition in the Western world. They're investing heavily in renewable capacity, and this has two strategic purposes for these companies. One purpose is to try and shorten their narrow their customer gap. So when I'm talking about the long customer position, is they want to close that gap between their generation and their power sales. They don't want to close it completely, because you want to leave a little bit of leeway, maybe 20 to 30%, where you can trade and optimize sales, but you want to cover the rest because it's a natural hedge. Renewables are a great way to match that gap, and also they allow it to increase the share of contracted earnings that the companies have, because most of renewables are actually are sold forward under PPAs, purchase price agreements, power price agreements, which are longer dated and are just in general a bit more insulated than fossil fuel based generation and wholesale benchmarks in general. And the other strategic intent, of course, is, like Gerben said in the beginning, is to drive the energy transition, to decarbonize the power generation sector and bring down those emission metrics. So on that front, we've seen Europe already come out with very ambitious plans to cut itself off Russian gas. Not only the Repower EU plan that Gerben already went through, but also country-specific plans to accelerate renewable growth. We've seen Germany step up their ambitions to bring forward their renewable targets to 2035 versus 2040 earlier, and a similar trend in the UK energy security plan. So this chart here shows us what is the pace of growth that we can expect overall in renewables. So this combines offshore wind, onshore wind, and solar PV across the major utilities. Although we should look at the chart with a pinch of caution, given that the companies that show the largest or the greatest potential for growth are usually the ones with the lower base. But in general, we can take the integrated majors average of about 12% as sort of the norm or the pace of growth that we can expect for the sector. If we can move to the next one. Right. So this chart dovetails great with what Rob was telling us before, that solar seems to be the quickest avenue to wean ourselves off Russian gas, at least in the power generation demand part of the equation. It seems like European utilities already heard about this 27% CAGR that we were talking about and decided it wasn't enough. We're seeing our analysis on management guidance actually suggests that between 2021 and 2025, solar capacity is set to grow by up to 50% per year. And this is because that 12% growth that I was talking about in the previous slide is mainly driven from a low base of solar in Europe at the moment, but with a great expectation to accelerate. And of course, we have to take into consideration that these targets include also the European utilities' presence outside of Europe. But we can see that it's a very aggressive pace of expansion. Next slide, please. Finally, just to try and summarize where we're coming from in terms of the power price volatility at the moment and what can come after. As we can see, this is a chart. Well, this is a chart of consensus estimates for EBITDA for the major utilities in Europe for the top 8. And as we can see, most consensus estimates predict or expect for a dip or a deceleration in earnings in 2022, and this is mainly driven because of the power price volatility we're seeing in the spot market. Nevertheless, consensus and the market in general expects growth to return from 2023 and drive forward from 2024, 2025, and beyond, probably until 2030, like most utilities are expecting to. So this is the picture that we have for the next 12 to 18 months. But now we will talk about the capital allocation strategy and how this may affect things going forward. So if you could please go to the next one. Thanks, Roger. Finally, we see earnings pressure in the near term. So now we want to see, as the crux of it is, how will this affect how utilities invest in the next 3 to 4 years? What we can see is that utilities will increasingly stay focused on growth capital investments. They will keep on trying to harvest opportunities from the accelerating energy transition in Europe. And as we can see, consensus EPS compound annual growth is about 5%. That should help fund a median capex growth of about 7%, which means there will be a shortfall. That means you will either have to increase debt levels or sacrifice dividends. And as we can see from the chart, most companies will try and sacrifice, will not hesitate in sacrificing dividends to keep on investing at these levels of about 7% growth per year, with leverage set to keep relatively stable, assuming that earnings catch up to debt levels from 2023. And this does have implications in the near term, because this means that leverage will likely increase in 2022 throughout the year end, and this will peak. And this will, of course, affect perhaps or pressure the dividend for the next few years. Next, please. And finally, just to touch upon about financial conditions and rising bond yields. So Gerben mentioned that yes, economic conditions are tightening. We see rising interest rates, we see rising bond yields, and this in general for the valuation of utilities is a negative thing. Just because utilities are seen as a bond proxy, as an alternative of secure income for investors, and if you have bond yields that are yielding higher, sorry for repeating myself there, yes, investors will perhaps favor fixed income versus a utility that yields a dividend. And the other thing is rising interest rates will have mixed impacts on the performance of these companies. So companies that have network assets or companies that have regulated networks will perhaps be a bit better positioned to mitigate rising cost levels in the near term, because most of their tariffs are indexed. This means that the amount of money that they get paid on operating and investing on distribution networks will get indexed to inflation. Plus, the amount of capital also is made on real terms in most jurisdictions, with a few exceptions. There will be pressure on the cost side if it's sustained. And the other way that that utilities can sort of hedge against inflation is by placing, as we said in the beginning, placing power prices at higher levels, or fixing or locking in higher prices for the next few years. If we can go to the next one, Roger, please. And finally, just to wrap it all up, because I think I went through a lot of it very quickly, so I'm just going to try and summarize it. Supportive drivers, or the key takeaways, or the pros for the utilities group is perhaps renewable capacity growth. It continues to be a strategic imperative for these companies, and it will fortify the defensive nature of utilities over time, will improve margins, and this is why, as we can see, the capital allocation and all the strategies are just to keep on closing that customer gap with renewables. This means that margin will improve in 2022, 2023, and so on, which we'll see the impacts of this as margin pressure on the retail side eases. And finally, Europe's pivot away from Russian energy in general will yield opportunities to accelerate renewable growth, and also perhaps for networks, or more investment in networks to connect those renewables. And well, as also Gerben said, hydrogen will present opportunities especially for those utilities with exposure to gas infrastructure, because they present this alternative to fix that stranded asset risk. But we didn't put it on the drivers in the near term, because we think hydrogen perhaps will be closer, will start to develop after the middle of this decade. And finally, the risk, as you can see, the risks are a bit longer. Sadly, the list is a bit longer. Looming gas supply disruption risk from Russia. So what we're talking about there is a full curtailment of gas from Russia. This would, of course, present a structural risk, not only for the companies that receive supplies from Russia directly, which are a lot of mainly German and Central European utilities, but it will actually cause a structural damage to the power market in Europe, will definitely send power prices through the roof, and will demand regulatory response that's very aggressive, like Gerben also alluded to, perhaps more government interventions. The governments may need to step in, because utilities would be, in that case, relieved of their contractual obligations to procure gas. So this will mean that governments will need to step in. Another risk, perhaps, is leverage. Leverage will peak, or we expect it to peak in 2022, given these dynamics, and this could hurt the pace of investment moving forward, especially for the companies that have higher levels of debt. Valuation metrics are pressured by rising bond yields. We already spoke about that. And finally, the key risk for the renewable opportunity amongst utilities is inflation. So rising costs means rising costs of procurement and equipment and building. There's rising competition from smaller developers as well. And also, another key point that perhaps the Repower EU was not particularly robust in was in how the EU plans to fix the permitting delays affecting the renewable sector. And with that, I'll hand it back to you, Roger. Thank you very much.
Okay, well, Gerben, Rob, and Patricio, thank you for your fascinating presentations. Everybody, thank you to those who put some questions in the chat. Everybody else, please put them in the chat, and you would love this to be an engaging session. I see there are a couple of questions here. Gerben talked about bottlenecks in the system, highlighting the power grid, material prices, and labor. It came up in Rob's and Patricio's comments. Perhaps you could just address what the soaring material prices are going to mean for solar and renewables in particular.
I think that's a question to Rob. Yeah.
Yeah.
Sure. Yeah. I mean, I'm happy to take it and have others weigh in. Look, if you look at the wind and solar manufacturers right now, 2022 looks like a pretty tough year. They've got cost inflation. If it's in the case of wind, it's a big function of what's going on in the steel market. In the case of solar, it's a big function of what's going on with polysilicon. I'm of the view that there's no cure for high prices like high prices. So my expectation is that through time, one of two things will happen. One is that the wind industry and solar industry will essentially pass along higher input costs to their customers. So it'd be something that consumers would pay for, or we'll get a price response in steel and polysilicon and get potentially lower equilibrium pricing. Now we're already seeing this trend unfold. If you're looking at the wind turbine manufacturers, they are passing on higher costs. So if you want to look on our dashboard, reach out afterwards if you don't know where this lives, but we can show you that the prices for wind turbines has been going up over the last 12, 18 months. Very similar. Solar is also in a world where prices have been increasing. But I think the big thing to point out on that is that if you kind of zoom out a decade plus and look over the last 10 years, we've seen massive cost declines, big technology improvements. And so in general, I would say wind and solar costs have been deflationary. In the very short run, we've seen some run up, but they're still very competitive at where the prices are today, in my view. And through time, I think there's a potential to get some, new supplies of polysilicon and some price response in the steel market that will potentially get back to those long-term downward trends.
Oh, thank you, Rob. Next question, I think probably for you, Gerben. The Repower EU, you highlighted heating and feedstock as a very hard place to achieve savings. What do you think they can do to tackle this area?
Yeah, well, not so much in the very short run. That's the uncomfortable truth. Energy saving is really important, but companies can also do so much. We expect that if you look at energy savings, a company can only save like 10 to 50% of energy in the short term, let's say 1 year to 2 years, without curtailing its production. Of course, you can save a lot more energy, but that comes at the cost of lower production. So energy saving is an important one. You can substitute some gas with biogas. We see some initiatives, for example, in the Netherlands. Some companies can switch gas to coal to a limited degree, but that's all in the realm of substituting one fossil with the other fossil fuel. So as Rob also rightly said, hydrogen is still in the piloting phase, and it will speed up the pilots. This current energy crisis. I also think that what Rob told us, the decline in power prices will lead to different business models for hydrogen, for example. So more co-location, that renewables, wind turbines, solar panels are directly linked to electrolyzers. Like in the past, we tended to connect them to the grid. So we will see different business models, but that takes a couple of years. So in the short term, not so much, unfortunately.
Okay, next question is on the capacity side, Rob, for solar and wind. Is there enough production capacity to achieve some of the very robust growth targets that you're outlining?
Yeah, so a couple of things. One is that I think industry is rising to the challenge. So if you look across the spectrum of companies that are involved in the solar supply chain, you're seeing an incredible investment wave occur to bring on new production right now. We just recently closed a focus idea on First Solar. And basically, the idea was that, the First Solar was investing in building a new production facility in Ohio, and it's also building a new one in India. And we think the volumes from those could drive consensus sales estimates in the kind of 2023, 2024, and 2025 range higher. And essentially, consensus has come up since we put out our idea. But they're investing, and they're going to more than double their output of solar modules over the next couple of years. SMA Solar, not a module maker, but they make inverters, just the other day announced that they were going to double their inverter manufacturing capacity from roughly 21 gigawatts to 40 gigawatts. They say they're going to have it all online by 2024. So whether you're looking at the module makers, the polysilicon producers, the inverters, this industry is a growth industry. It is not at a standstill. And I think that, I am not concerned, at least here in the near term, that the limiting factor will be productive capacity. If you can make a solar module, there's a market for it today.
Maybe on the same sort of theme about permitting, which was touched on in several of the presentations, do you think politicians are going to find solutions to speed up the development projects?
Yeah. I definitely think there will be a lot of proposals, especially in Europe. It still remains to be seen whether they will actually make a difference in practice. Europe now tends to phrase renewables as a public good or a necessity. And therefore we can relax on regulations regarding the environment or whatever. But I think that other people, like environmentalists, will also claim that the environment is also a public good, or biodiversity, or what. So I think ultimately judges will decide what the balance will be in practice. And we're up for some court laws about the policies that will come into practice in Europe. And that takes some time, of course, and balancing of powers, and pros and cons. So I'm happy to see how this will play out. Rob, any additions to that?
Yeah, so I mean, look, I know we've got some real practitioners on the call who are listening, who are out in the market trying to build projects day to day, and so maybe they've got the best concrete view. So feel free to weigh in on the chat. But what I would say is that, look, the NIMBY argument is big, but perhaps the move towards offshore in wind is going to help that. You don't have as many stakeholders when you go out, 20 miles off the coast, telling you, no, we don't want that in my backyard. I mean, there probably always is going to be some pushback. But the way I kind of think about the very near term is not so much that it's hard to get all the permitting sped up and solutions, but what I think you can do is, given the lead time for a lot of these projects, if you have a project that's supposed to be online in 2024, can you do it in 2023? Can you pull it forward? And I do get the sense that policymakers are having those kinds of discussions with some of the companies doing the development work. Not too long ago, in the UK, Prime Minister Boris Johnson and government officials from the UK sat down with BP and Shell and others, and after that meeting, they all came out and said, we're divesting from Russia, right? So if you can do that with an oil major, I'd be pretty surprised if you aren't having sort of analogs with the folks doing wind, solar, and other things and saying, hey, how quickly can you get this done? And so at least in the kind of 2022, 2023 timeframe, I see it as more about pulling forward the existing project queue rather than sort of developing new projects out of thin air.
Yeah, I fully agree to that. And I would like to add that I also think it will trigger a response to not only look at it on a project per project basis, but really combine portfolios and see the big planning permits, the regions where we can add a lot of offshore wind power, onshore solar. I was very pleased to hear that Repower EU also thinks about an obligation to put solar panels on your roof. So it's not a thing you can decide for yourself. So there will be much more integrated policies than simply on a project by project basis.
What about just extending the conversation into distribution is obviously going to be critical as we move more to electrons? From a permitting perspective, can we bring on the distribution and link up all these new solar and wind farms? Patricio, any views on that?
Yeah, I can speak briefly to that. I think, I think again that touches upon policy a little bit, at least in the short term. I think echoing what Rob and Gerben were saying on that front is we do see a little bit of a time like these delays in the short term are not only local community opposition or permitting delays that are purely bureaucratic, but it's also parts where the grid is just not prepared yet to connect this rapid level of growth in solar and wind. Perhaps an example is in Spain, where solar capacity has grown so much, but it just cannot connect equally to the grid as the other technologies that it actually cannibalizes itself, cannibalizes the subsidies given to that technology. And that's mainly an infrastructure problem because we're still seeing a delay. One good way to see it or to try and understand it, because it's very difficult to get into the weaves of which company is investing how much and so on. But without getting into the weaves, if you look at the renewable capacity growth target as a group, as a peer group, is around 12 to 14%. And then if you look at the peer group of the network utilities, which are handling the distribution networks in general, their compounded annual growth is closer to 5% in terms of reinvestment. This has to be caveat, of course, that we already have existing grids, so we don't need to replace them or build them from scratch like we do renewables. But there does seem to be a little bit of a lag in terms of how much money is being deployed to upgrade and expand our network infrastructure.
Maybe while we're on sort of network infrastructure, another question looking at the intermittent nature of wind and solar and what it means to the network for reliability. Rob, Gerben?
Yeah, Rob, can you take it one?
Yeah, sure. Look, at the end of the day, I feel like it's a regular occurrence for people to remind us that the sun doesn't always shine and that the wind doesn't always blow. I generally think that grids are very dynamic. They essentially clear in real time. You flick your light switch on. You don't always leave it on, right? The demand is always changing, and the supply resources on the grid are always changing. I do think you certainly need what would classically be described as baseload power. And if you reflect back on the slides I had, and happy to share those afterwards, but we did a scenario. One of the things I didn't give all the caveats to our scenario, but one of the things we did was assumed that if your goal is to reduce reliance on Russian gas as quickly as possible, that you might really should consider running your coal fleet if you can. And so we think it's likely that at least in the near term, Germany and some of the other countries in Europe will take a little bit softer approach on some of their coal phase out plans to help balance out that intermittency, and especially if you're trying to take gas out of the system, one way to do that faster is to not push your coal out of the mix. Frankly, I'm kind of surprised that Germany hasn't reconsidered its position on nuclear. I think they have, and they've decided they're still going to shut those off, but that would also be pretty meaningful if they kept those around.
I think the next question is on the same theme that we've been talking about, looking at polysilicon prices. Rob, somebody's obviously been reading your work about your call for decline when it's actually gone the other way recently, up towards but stabilizing at 40 kilograms, $40 a kilogram. What has been happening here, especially linking into some of the capacity coming out of China?
Yeah, so roughly today, PV grade polysilicons most recently at 32 a kilogram. It was a little higher late last year, and we are essentially of the view that the long-term downward trend could return. What I would say is just that generally we have a lot of new polysilicon supply coming online. If you look at all of the factories that produce polysilicon that are out there in the ether, new production capacity, if you actually complete all the facilities that are under construction, we potentially more than double the amount of supply available to the market. We think this could have downward pressure on what happens in the market. And one of the things that we often take a look at is, what's the variable cost of operating your polysilicon facility, and that is at a much lower price than where we are today. So variable costs are kind of in the $9-10 per kilogram range, and so as these new supplies come online, that's potentially going to have an impact on prices. And like I said earlier, nothing, no cure for high prices like high prices. And we do expect the supply to come back in line. That being said, I don't know. Everybody's got their own crystal ball. Even if we sustain where we are, I think the solar PV industry is poised to continue to grow, and they'll just end up passing those costs along if that is indeed the new normal.
Okay, thank you. I think the final question you might be able to do, Gerben, looking at US tax benefits from PTC and ITC and what it means for visibility for renewables OEMs. I'm not sure if you have a view on that.
No, I don't have. I focus on the European countries mostly, so can't answer that question.
Okay, I think it's maybe one we'll try to find an answer from our utility analysts out in the US. They might be able to put a bit of color there. I think that is all our questions at the moment. If there are any final questions, please just quickly put them in the chat. And while you do that, I'd like to thank Gerben, Rob and Patricio for their fascinating presentations this afternoon. The replay will be available. The slides can be available, so please reach out. And we've got. Nope, it's just a nice chat. So maybe I can't beat that. So thank you for that. So that will conclude today's presentation, and we'll hopefully see you on one of these events soon. Thank you.
Bye-bye.
Thanks, everyone.